Welcome to the Markets Happy Hour podcast, a weekly markets update for investors the world over. Each week we discuss inflation, geopolitics, interest rates, equity markets, and other asset classes. To try to answer the question, what does this mean for my investment portfolio? Let's dive in.
What has been very interesting has been in the past, say 6 to 9 months ago, when a company announced it was prepared to spend vast amounts on CapEx, this was celebrated by investors. Investors were very clear about the points they would give for certain behaviors that they wish to see in their underlying holdings. One was being savvy about AI, being, I think, on top of that, showing that they were likely to be leaders in that respect. And spending was at that time seen as a signal of their leadership. Similarly, when we saw cost cutting, that was again celebrated by investors. They were very much in favor of seeing margins expand and seeing that disciplined cost cutting occur by CEOs. And that was being celebrated. So when something is celebrated and rewarded, we see that then being copied across the board. Now the mood has changed somewhat around CapEx build out. And what we can see is that there has been a reticence to reward a CapEx build out, and even a wariness as to whether that would all be sustained. The percentage on this is according to the Bank of America Global Fund Managers Survey, that the net percentage that say that companies are over investing with too much CapEx has gone from a negative now strongly into positive. And that has been a very dramatic change just in the past few months. Of course, we could say that this is groupthink, and that when we see the Global Fund Manager Survey, there is remarkable marching in sync around these points of view and very little contrarian thinking. But I think this is very notable that this is where the pendulum has now shifted. And let's break down just some of this expenditure. What we can see from the chart on the left is that the CapEx of these hyperscalers has soared. Free cash flow remains high, but let's watch that and put a pin in that for the moment. And debt issuance has continued to rise and rise somewhat sharply, certainly relative to 24 and 23, again, to fund much of this build out. In the past, we have seen that this debt issuance in the recent past has been actually quite celebrated by markets because they have been clamoring to get access to this debt. It is seen as a good credit and was seen as a good use of funds. But we can see, though, that there are still quite dramatic differences over the past few years in terms of that spending. When we look then at the cash flow, the trailing 4-quarter free cash flow, we can see the cash flow has been declining in these hyperscalers. That's quite evident in both charts, on the left as on the right. And over the Q4, cash flow has been declining, which is suggesting that this CapEx is starting to erode the cash flow. Now, of course, the cash flow, this is what it could be used for, but the fact now that cash flow has started to fall in net terms suggests that this money for CapEx is being taken from somewhere else. And if it continues to fall, this will equally crimp the investment that is likely to be spent on other areas. So again, this is a trade-off, and investors need to decide what part of the trade-off they are comfortable with and what part they are likely to penalize.